Sure. So warm welcome, everyone. I think today we are looking forward to a very exciting masterclass, and nothing other than it could be as exciting like real estate. So we know there are tons of things happening in the real estate space. Possibly it's one of the sunshine sectors right now. And we do have some pickup in interest in the real estate. And to discuss all of this and more, we have Mr. Om Ahuja with us today. Om has got a treasure of wealth of knowledge and experience. He has over 24 years of experience in the sectors, and he started off being as a wealth consultant with Merrill Lynch in India, and went on to work with ABN AMRO, Yes Bank, and then he moved on to the real estate of the infrastructure and went on to become the CEO of JLL and the Brigade Group. He has wide experience across real estate, infrastructure, construction, hospitality, banking, financial services, and manufacturing. So with that introduction of Om Ahuja, I welcome Om Ahuja to today's webinar, this masterclass, and we look forward to a very exciting session, Om. With that, I hand over the floor to you.
Thank you, Sujay. Good evening, everybody. It's as Sujay has mentioned, everybody is interested in real estate, not because it's a great sector to be in. It's primarily a sector where people have very limited choice. Because end of the day in India, country like India, where real estate becomes a part of your portfolio unknowingly. You inherit a portfolio, you invest into a portfolio because you need it, or there is a social status attached to a portfolio of a holding what you're holding in terms of real estate. So in today's session, what I will do is I will try to walk you through various things in the globally what are happening and what happens in a portfolio in an individual investors of India, and how a wealth manager looks at it. It's very important that a wealth manager looking at a portfolio which is having real estate is very important, because many people consider this as a very crucial and very important part of your portfolio. That makes it very important for you as a wealth manager or somebody who's intending to become a wealth manager to understand the psychological and other compulsions that makes real estate a part of your portfolio. How to handle a customer, how to handle the real estate portion in your portfolio. I have Meenakshi with me, who's going to help me in walking through the slides. I have the first slide, which says how much is a real estate part of the net worth in terms of how is the real estate, what portion of the real estate is in the net worth component in India versus globally. Most of you will be surprised where the world ends, India starts. Due to compulsions, various different things, India has been a place where most people have no choice but to invest into real estate for various reasons. We'll discuss those in detail a little later. So you'll see globally, average holding in a real estate by choice or by compulsion, it's max 25%. Whereas in India, if you go to northern part of India, you'll find the proportion going extremely high. And in southern and western part of India, it is moderately high. So why is this? How it has happened? Why is it happening? We will discuss that. So globally, real estate is not considered to be a must-have in the portfolio, whereas in India, it is considered to be a must-have in the portfolio because of various government policies, or primarily historically, the real estate returns have been amazing. Capital gains specifically, not in terms of yield, but in terms of capital gains. So next slide, Meenakshi. The most important decision anybody has to take in India at this point of time is, do you want to own a house or you want to rent a house? Why do you get to that situation? Because most of the times, renting a house becomes more financially meaningful, because the rental yields in India historically for last 3 to 4 decades have been extremely attractive in terms of for the person who is going to rent them out, not for the person who's going to invest them. If you look at a rental yield of any residential apartment, house, or villa, you will find nothing beyond 3%. The question lies is, if you are going to make more than 3% on your capital, if you deploy this money into any other asset class, why will you lock your money into a real estate, specifically residential real estate? That's a larger question. None of us have in India why people still buy real estate when you can rent it at 3%. Why do you want to block it? And it's the same money if you deploy it in any other asset class, whether it is bonds, deposits, stock market, mutual funds, anything that gives you beyond 5, 6, 7, 8%, which is more than double or triple of the return what you get in a rental yield. Why will you like to block your money? If you look at the historically the data, what it shows is in the last 15, 20 years, 30 years, over a period of 10 years or a period of 20 years, real estate has given you the capital gains or so-called capital appreciation, which has been unbelievably high. And why is this happening? There are critical components like urbanization. Very important in India is there are few cities which are growing beyond imagination. There are few cities which are not growing. So the cities which are growing have seen the benefit because of land is limited, whether you call Delhi or you call it NCR or you call it Mumbai. Most of the cities have seen unimaginable growth in terms of capital acquisition, primarily because the land is limited or you have the supply is limited. Keeping that in mind, you have various policies of government which control the supply. Now, let me give you an example in Mumbai. You have FSI floor space index is a norm which Mumbai Municipal Corporation, and now it's meaningfully every other municipal corporation in India has started copying that. They sell construction space, the right to construct, to any builder or developer. They have to pay a premium. So let me explain in a very simple language. If you have a land, how much can you construct is a question mark anybody will have. You can say, I can construct as much as you want. No, it doesn't work that way. So municipal corporation tells you this is a norm you have to follow. So much you can construct. If you have a land which is basically, let's say 1 acre, you can so construct 1.33 or 1.45 times. Beyond that, if you want to construct, every extra additional thing, there is a norm, there's a table. Everything addition to whatever you have right to construct, beyond that, you have to pay premium to the municipal corporation. What do you mean by premium? It's nothing but a royalty you have to pay to the municipality. So if you, let's say, for example, you have a 1 acre land, you can do 1.33 times of that construction. If you want to go beyond 1.33 times, you want to go 2.33 times, there is extra money you have to pay municipality. So there are various terminologies called premium FSI, fungible FSI. You have TDR. The norms are basically very complicated, methodical, but they are all nothing but the money which is going to municipal corporation for building that extra thing what you want to build on a plot. So there are new things which have come up recently, which is basically if you have a metro passing through a property, you can go up to 4 FSI. Yes, 4 FSI you can go. Doesn't mean you can go free. Beyond 1.33 times of your land what you hold, beyond that, till 4, you have to pay money to the municipality at the market rental value, whatever market value. So the market ready reckoner rate is defined by the municipality or the government of Maharashtra or government of any state. Beyond that is something which you keep paying premiums. That's why you start seeing the rates in city like Mumbai or Delhi have shot up, primarily because premiums have gone up in last so many years, and premiums are directly linked to your market ready reckoner rate. So when you have this kind of methodical formula rates being applied to any real estate properties in Bombay, Delhi, what happens is you are over the years, last 30, 40 years, the rental ready reckoner rates have gone up, premiums have gone up. So if you buy a property in Bombay, Delhi, you're paying through your nose just because the premiums are high, not that builder or the developer or anybody else is making money. The land rates have almost stagnated in last 10, 12 years in Mumbai city or Delhi city. But only thing which has gone up is premiums. So who's getting more? Government is getting more. So this is a mechanism which many other cities like Bangalore, Pune, Hyderabad, not Hyderabad, Chennai have copied that. Hyderabad is the only city in India which doesn't have FSI norms. The government of Chandrababu Naidu opened up 20 years back saying that in Hyderabad you can go as high as you want. Government doesn't bother how much high you want to go, how much you want to build. It's free FSI model. Internationally, that's the same concept. Only thing you have to take care of is airport authority. Airport authority gives you a height permit. Beyond that, you can't go. Till then, you don't pay any premium to Hyderabad Municipal Corporation. So if you see today, Hyderabad is one of the most reasonable markets where the FSI norms are relaxed. And that's the reason Hyderabad rates or property rates have not shot up in last 10, 20 years. That's a negative for an investor, positive for a consumer. So keeping that in mind, capital appreciation many things happening in India has kept the dilemma, should I be on rent or should I buy a house? So HNI investors or any investor, including you, me, everybody, would like to see that we have some capital appreciation in the portfolio because we have limited choice. In the past, we had very limited choice in terms of investing our money. In last 20, 30 years, people had challenges of inheritance. People had challenges of redeploying the money. People wanted to migrate to city like Mumbai because jobs were in Mumbai or jobs were in Delhi. Fortunately, in last 10 years, we've seen the job scenario has completely changed the dynamics in India. You'll be surprised. A city like Pune, a city like Bangalore is now attracting the maximum amount of institutional players. You will find most of the technology companies are opening shops in either in Bangalore, Pune, Chennai, Hyderabad, Gurgaon. Their choice of city in Mumbai is not there or Delhi is not there, primarily considering the cost involved in the cities. So you will find any new campus placements, the kids or maybe the youngsters getting placed are not happening in Mumbai, Delhi. They're happening in either of this Bangalore, Pune, Hyderabad, Chennai, and Gurgaon. This has led to unimaginable growth in these cities. We are continually saying that these cities are growing beyond our imagination. And these cities are basically where you have youngsters coming and buying the apartments or so-called property. So that thing is going to lead into a capital appreciation, which is we have seen a city like Bangalore, which is to cost anywhere between 4,000-5,000 rupees, has now become 7,000-8,000 rupees on an average street. This jump has happened in the last 4-5 years. So this is where a investor looks at saying that if I can make double the return of my other investment, which is bank deposit or a bond, why shouldn't I look at real estate? So that's where the compulsion lies. Next slide, Meenakshi. So let us look at what is globally phenomena in terms of investments into real estate. Specifically, how many people look at buying a house or renting a house? So we have a situation like, let's say, for example, New York, or in a city like which is Berlin, which is having 65% of 67% of people living on rent. There, the compulsion of buying a house is not as much as we see in India. Let's look at Singapore. 65% of the people live on rent, primarily because government has very good attractive rental schemes or public housing schemes. A city like Mumbai, Bangalore, Delhi, the data is estimated data. The data is not in the public domain. Many portals have gathered this basis, being that anywhere between 35 to 40% of people live on rent. Balance people own apartments here. Whereas if you see a city like Tokyo, that also has very similar trend to India, which is having 21% of India people in Tokyo live on rent. Balance people own an apartment. So there are abnormal trends. We can't catch any specific trend line here. But most important thing is, what is the compulsion in India for people to own an apartment? Primarily because of government policies. Many places in India, almost every part of India, you have to have a permanent address, correspondence address. You have to have a detail being submitted to every government authority, whether it's passport or maybe any other government authority is asking you for permanent address. People start thinking that, okay, let me buy an apartment or let me buy a house. Whether it is a boy getting married or a girl getting married, the boy getting married, people check, does a boy own an apartment? Does he live in his own apartment? So there are challenges which are beyond imagination. They are more to do with how do you manage these compulsions? There's no solution to this. So there are challenges which people say, okay, I have a holiday home now. This is a new trend which is catching up in India, which is similar to China. People have more than 1, 2, 3 apartments or more 1, 2, 3 or holiday homes, primarily keeping in mind that their lifestyle is becoming different. And in off late, in the Corona times, COVID times, we've seen people going and buying holiday homes beyond our imagination again. People are now buying holiday homes just to see that there's a Wi-Fi connection. I can work from home anywhere, any part of this country. So that's a trend which we could actually analyze and present in this slide. Next slide, Meenakshi. We discussed this. We'll go to the next slide. What has been the return in a real estate phenomena? Let me now give you a larger picture here rather than giving you specific cities. So again, primarily returns historically have been capital appreciation. barely covering inflation. Specifically, when you look at return from a residential real estate, it's hardly 1 to 3%. It hardly covers your inflation. It in terms of how do you basically manage in terms of growth? There is no discussion on it. But if you look at capital gains combined with your rental return, then it is unimaginable. Will it sustain? We'll discuss that. Commercial properties, primarily, if you look at a commercial property, the rental return from a commercial property is anywhere between 8 to 10% across India. Unfortunately, the rental return what you get from a commercial property, if you want to borrow money and invest into a rental property, you barely cover your costs. Does it make sense? Absolutely not. We'll discuss that in detail. Reason for having this people chasing this real estate in India, it's primarily for capital appreciation. Meenakshi, next slide. Before we jump into this, let me walk you through what is the reason, primarily keeping in mind real estate being a choice of investment. There are multiple reasons. One, in India, because in the past, people, HNI specifically, like to park money in real estate for multiple reasons. One is rental yield may not be attractive. Capital appreciation can be attractive. The second point primarily being is parking your cash. Unfortunately, in India, there is a parallel economy, which is cash economy. In the northern cities of India, specifically where people trade houses, there's a significant amount of cash which is involved in every transaction. So real estate has become a parking place for unaccounted cash, specifically when it comes to real estate. Whether it is gold or real estate, and historically, the component of cash in a deal has been as high as 70% of your cash gets absorbed. So that is a big, big driver for a lot of HNIs to park money in a real estate form. Why has this been the trend? I think hopefully after demonetization, we have seen this trend being a historic discussion in many larger cities like Bangalore or Bombay or Pune or Hyderabad, where the salaried people are larger component of people transacting. But even today, if you look at HNIs, ultra HNIs transacting, there is anywhere between 10, 20, 30% which cash components happen. This is specifically when it comes to a larger transactions. I'm not referring to a transaction where it is 1 crore, 2 crore, where the salaried people like you and me have this, parking money. We primarily look at taking a home loan, or we look at parking our own investments. But when it comes to HNIs, they look at leverage. So when you call leverage, that's how they look at multiplying the return from the bank borrowing and investing. So when you are looking at multiplication factor, it doesn't make sense when it comes to deploying your own cash, but looking at a bank borrowing and your cash component being absorbed, that is where the real multiplier comes in. So let me walk you through what are the different types of real estate investments in India. When you will meet a HNI investor, what is his portfolio will comprise of? Agricultural land, primarily inherited. Very rarely we hear people buying agricultural land out of their investments. New trend which is catching up, but this is very, very, very new trend in India. Non-agricultural land, again, primarily inherited. Very few people go and buy a non-agricultural land as an investment. Third one, which is plots, which is a trend which is catching up across India, primarily keeping in mind appreciation what you get in a land, which you don't get in an apartment. So it has been historically seen plots in a gated community within the city or outside the city limits give you multiplying effect because of scarce commodity. That's land is a big scarcity in most of the cities. Whether you go to a small city like Chandigarh, I'm sorry, I shouldn't be referring as Chandigarh as a small city. It's the capital of 2 states, but Chandigarh still is a place where getting a land is a big challenge. So if you look at a Raipur, or if you look at a city like Coimbatore, land still is a biggest driver there. People are crazy about investing into land. Even if you go to Kerala, the land is something which is people consider as to be really important, because you like most of the Middle East or global NRIs who hail from Kerala will always go back and invest money into Kerala specifically. And off late, with scarcity of land in Kerala, they are now migrating into Bangalore or Karnataka or the neighboring Tamil Nadu. The fourth one is a villa and a row house, which is primarily reflecting your status symbol. Anybody owning a villa and a row house in a city like Bangalore or a city like Chennai, considered to be very, very well-to-do. If somebody is owning a house in Bombay or Delhi, is considered to be ultra super HNI. So these are the trends which typically go with any investor, when you meet an investor from the film industry, you'll find villa and row house is something which they basically like to discuss in the city limits. Of course, when you go to a Lonavala or you go to a hill station area, villa and row houses can be afforded by any salaried class also. So again, it's a trend which differs with individual portfolio to portfolio. Then we have apartments, which is, we all know what apartments are, which was a trend which started up around 30 years back. And this is a trend which is continuing to be gripping. It's almost second tier, say third and fourth tier cities now. We have seen cities like Kochi, we're sitting cities like Coimbatore, where apartments have become a trend to stay in. Earlier, this was considered to be a taboo. Who will stay in an apartment? I can own my own land. I can own my own villa. As simple as we've seen this trend catching up in terms of not only in terms of economies of scale, but in terms of quality of life. Because most of the apartments are gated communities where you have a lot of amenities built in. Whereas an individual who basically wants to live in an individual villa or house doesn't have access to the amenities like tennis courts or the gym or a swimming pool. So all these things are being packaged by the builders and developers in apartments across India. Independent house is something somebody inherits, and these are things which are converting into a 4-story, 5-story buildings across Delhi, North India. You'll find most of the independent houses now getting converted into apartment buildings. Then we have shops, which is most of the people who are into business, they consider owning a shop rather than renting a shop. Offices of two formats, small offices and large offices. Large offices where large corporations are basically taking it on rent, like tech parks, or maybe you have commercial tech parks and many other things which are happening in India. Many parts of Pune, Bangalore, or Hyderabad will see this large office formats, which are full buildings occupied by big players like Microsoft, Accenture, Cognizant. Then there are malls. Malls in India have been a success and a failure. Malls in India where a lot of HNIs have stuck their money. People who bought individual shops in a mall have suffered. People who basically have invested into a mall as a floating investor also have suffered. So the malls in India are a concept where a developer, if he has sold the shop or if he sold a space to a HNI investor, is always not seen the good returns. Malls which are owned by institutional investors and run professionally, where there is no individual ownership, have seen super success. So malls investment by HNI is considered to be a no-goer, because in the last 10-15 years, we've seen nobody making money as an individual investor investing into a mall. So that is a trend which has not caught up in India. It had caught up 10 years back, but slowly it's dying down. Then we have hotels, small size, large size. Many hotels in India primarily are owned by individual HNI investors, run by the professional operators, which is whether we call it Marriott, we call it Hilton, or any other operator which basically runs the hotel. Hotels as an investment have never justified the logic of ROI. They've never justified a return logic, but still hotels are considered to be a safe place for parking large amount of money, where people don't know what to do. They only look at appreciation as a land or the hotel property. And the last one is resorts. We have a lot of resorts being created as today we speak. In today's economic times, there was a deal which one of the large infrastructure companies promoter has bought a land, big land and resort in one part of India. So this is again where a lot of HNIs get attracted to buying hotels and resorts as a long-term, very long-term investment for the portfolio. Next one, Meenakshi. So what is a larger discussion? Are we saying that, are we looking at residential property or commercial property? If you are an advisor to your customer, if you are an advisor to your HNI investor, and somebody is asking you this question, if I have X amount of allocation in my portfolio, let's say 20% allocation in my portfolio, where should I put my money? Whether I should keep buying apartments and give it on rent, whether I should buy commercial property and give it on rent. It's a no-brainer. Residential property gives you less than 3% return annually, and commercial property gives you anywhere between 8 to 10%. So whether as an advisor, would you recommend a residential property? Bigger challenges, you'll say no. But in the past, residential properties have given excellent returns. Will they continue to give excellent returns in the future? Is a bigger question mark. Because if the city is coming to a saturation point, when you have scarcity of land, will the appreciation continue? all depends upon the other parameters, which are whether job creation is happening, whether there are other challenges with regard to infrastructure. Many things come into play when it specifically comes to residential property in a portfolio return point of view. So there are a lot of HNI investors I have seen personally in my last 25 years of career, people who have 10 apartments, 20 apartments spread across 2-3 cities. The reason they have these apartments is primarily in the past, till 2 years back, there is to be a taxation benefit. If you borrowed money on a residential property and give it on rent, you make 3% return. But you used to pay, in those days, we used to pay around 8-9% home loan. And there used to be net 5% loss. Technically, on a capital gains point of view, on the income tax point of view, we used to basically have 5% net loss on a residential property, which used to be able to adjust against your other income, whether it was salaried income, whether it was business income. So a lot of people took that loophole as an advantage. Around 4 years back, this advantage in the taxation was withdrawn. So from then, you will see a lot of these HNIs who are using residential property rental return as a tax adjustment entry in their portfolio vanished. Now, if somebody says, I didn't understand this, let me re-explain it to you. If you had bought a property on loan, you are servicing a loan of 7% and you are earning a rental yield of, let's say, 3%. So you're net making 4% loss. Because you borrowed 80% of your money, you are actually making 6-7% loss in your return of investment when you look at a specific property. Whatever, let's say, for example, you're making a 6-7% loss per annum, you could adjust that loss against your business income. The moment you adjust against the business income, you have to pay lesser tax in your business income. So people didn't see that, okay, this is negative or positive. People saw it as a very good objective, very good exercise in terms of tax planning. After that was withdrawn, a lot of people exited residential properties as an investment from HNI portfolios. Sorry. So that has actually made it lesser attractive. But in the recent times, we have seen first-time investors, a lot of people who are coming from tier 3, tier 4 cities in India, passing out of colleges, getting jobs in Bangalore, Pune, Hyderabad, or Chennai, looking at buying their first house. I'm saying first house for that generation, not for the parents. Parents already own an apartment back home. So this is something which is driving the new demand in the cities. And this is something which is going to create next impact in terms of how the residential properties will give in terms of return, in terms of capital gains. One has to see that. It all depends upon the scarcity of land, all depends upon the supply. Till then, residential properties only give you 3% return. As an advisor, you have to make a choice. Is it worth investing or is it worth wasting your time? The second part to it is commercial properties. Many people fall to the gimmicks. People say, oh, I make 6%, 10% return in an office investment. I can lease it out to I can buy a small office. I can lease it out to a small chartered accountant or a lawyer. I will keep getting 6 to 10% return. Every year there's a renewal, or if there is a 3-year renewal, maintaining the property. Tenant tomorrow starts negotiating with you in terms of, okay, the property is run down. There's no proper maintenance. Give me a discount. In the recently COVID times, people have not got rental return for 7, 8, 10, 12 months. So those are the challenges, managing the property. All those things leave HNI investor saying that, okay, I have to manage so many things. Because HNI investor today has his own business. He has his own challenges. In addition to that, a commercial property becomes a headache because he becomes a property manager for it. Either he has to employ a specific person for doing the property management, or he basically runs the show on his own and he just earns 6-10%. With 6 to 10% today in a commercial property, appreciation being very limited, is it a worth investment? As a question mark many people have asked themselves. So of late, with last 2 years, Government of India made such rules which are basically allowed REIT, a real estate investment trust, which is like a mutual fund of real estate, has been in the market, listed units available online, which are giving you anywhere between 6 to 7% return pre-tax. Is it worth investing into a REIT, which is also giving you access to multiple cities, giving you access to multiple large properties like tech parks, where large tenants like Accenture or Cognizant are your tenants, or TCS are your tenants, or you want to buy your own small office and lease it out to a XYZ, and XYZ is giving you rental on time, not on time, smaller companies making you run around, maintenance, many other things are challenges. So commercial properties still is an attractive norm in many HNI portfolios. Of late, there have been instances where people are going and buying pre-leased assets. Pre-leased assets is nothing but an office which is already leased to a commercial player. It's already leased to a tenant. Somebody is offloading it. For example, builder built a whole building and he gave it each floor. He basically has leased it out, and each floor he is now selling it to HNI investors. They come and buy that particular floor. Mind you, there are legal, other and many other challenges which come into play when you basically buy a commercial property. So HNI investor has wherewithal, he has consultants, he has legal advisors who help them do. But of late, there have been a lot of these startups which are basically getting into the space aggressively, offering 1,000 square feet or 500 square feet or 2,000 square feet as a small ticket size investments into this space, which are very tricky. One needs to see legal title, which is very important in this specific space, because investment now, 5 years later, you need to see whether you can exit. The most important thing in real estate is entry and exit cost. So we will dwell that into in detail and in future. At this point of time, whether it makes sense to look at residential versus commercial, 100% as an advisor or as an investor, commercial makes a lot of sense. But in commercial, the larger question is whether you want to go for a commercial property or you want to go for a REIT. I would say if you have wherewithal and you have bandwidth, you should go for a property if you can own the property. But if you don't have bandwidth, you don't have a manager, you don't have a property manager, better to go for a REIT. You may sacrifice 1-2% return, but it is still a stress-free mode and much more tax efficient, much more property management efficient point of view. REIT makes a lot of sense. Meenakshi, next slide. We just discussed this. Next slide. So, what does it make sense? For a HNI investor, does it make sense to invest money into real estate, participate in the growth, India real estate growth story, or just stay cautious and buy REIT or buy apartment where he is staying? All these are personal questions. It's very difficult to generalize and say, yes, this is right strategy, that is not the right strategy, this is a good strategy. So of late, we've seen in the COVID times, people working from home, realizing, people realizing a larger home is very important, because a husband, wife, and 2-kid family, all of them were doing work from home and study from home. Everybody needed 1 bedroom each. So 4-bedroom was a requirement. Managing from a 2-bedroom was difficult. So people said, okay, I have a budget for 3-bedroom. Let me upgrade to a 3-bedroom. In last 24 to 48 months, we've seen a lot of upgradation happening. Will this continue? Suddenly we saw in last 2 years or last 18 months, demand for 1-bedroom has vanished from the market. So these are trends which keep changing. It's very difficult to say today that 3-bedroom will be in fashion for next 2 years or 3 years. We don't know. So after the moment the offices start happening, everybody starts going back to office from next 6 months or 9 months, which is happening globally now. After 24 months, people say, I can't maintain a 4-bedroom apartment. Let me move back to my 3-bedroom apartment or 2-bedroom apartment. So a lot of things will keep changing basis the current environment and the existing environment when the decision is being taken. So a lot of things are specifically related to each individual portfolio and each individual advisor at that point of time taking that call. Meenakshi, next one. This is a question which most of your investors or as an advisor, you will be in a situation to answer. Does it make sense to borrow at 6-7% when you can get a house for 1 to 2-3% rental yield? I'm giving you a very simple example. If I can stay by paying 3% rental yield, why should I borrow 6-7% home loan and buy my own house? Again, as we discussed in the last few minutes, it's again most important thing in India is with capital appreciation being so large, it's very difficult for investors to say that, okay, I'll continue to stay in 1 to 3% rental yield. I'll be very happy and not block my money. I'll put this money, balance money into a good quality bond or good quality stock or good quality mutual fund, continue to earn double the rate of return of 3% or maybe triple the rate of return of 3% and enjoy the house which I'm living in. But as we are growing country and we are growing population, nobody imagined 30 years back that houses in Bombay will be what prices they are today, which are unaffordable and very difficult to predict what will happen in next 30 years. So most of the people look at it as a hedging mechanism. I better take a home loan, better buy a property, sacrifice that return of 3%, 4% on the portfolio by just taking a home loan and not being on rent. That makes a lot of security rather than safety in terms of portfolio returns. And there's a social stigma. Many people have their own challenges, whether, should I be on a rent? Because moment you see a apartment complex, there is somewhere it may not be very clearly visible. Many people say, oh, are you on rent or are you on owner? So that title may be a lot of relevance in terms of many cities. But if you look at a Bangalore city where 40-45% of people are on rent, so that's not a stigma there. But it's become a stigma in city like Mumbai, Delhi, and specifically in Delhi, they'll ask you, are you on rent? So that is a question. A lot of people, it hurt their ego. And that if ego is managed, a lot of people can look at sacrificing that satisfaction of saying that, oh, I am on rent, no problem. I'm still making financial sense. Meenakshi, next slide. So I, in last 15-20 minutes, I've tried to cover the best out of real estate, what's happening in India, how real estate portfolios are looked at, how investors look at net worth allocation, and what has been driving factor. We have an interesting situation today where we have China as a situation where there's one large property company defaulting on their bond coupon payments. Why is it so happening? Quick analysis of China. Property prices have tripled from 2005 to 2011, very similar to India. Why is it happening? People in China again look at real estate the way they look at it in India. It's a safe way of saving your money, parking your money, and not getting, because there is a lot of challenge in China at this point of time is where do you park your money? Unlike India, you have different avenues to park your money. In China also, you have basically, there's a soft corner or there is a socially demanding factor to park your money into real estate. So that is a big factor which is driving China in terms of Chinese investors looking at parking the real estate. A rough estimate of survey which was done on one of the website showed around 70% of HNIs park their money of their net worth, they park money into real estate. So real estate has tripled the money, and that has been a big driving factor in China specifically. And that has led to a lot of industrial towns, a lot of growth in terms of real estate in China, which has led to creation of large companies which are into real estate. And one of the companies which has big investments or big developments has leveraged the money, and gone big in terms of scale. And that has now hurt them, and they are down defaulting on payments. Next slide, Meenakshi. So when the property market is overheated, we kept reading a lot of news articles in last 4 or 5 years. There are ghost towns being created in China. Rental yield is almost zero. Even then, people keep continuing to buy property in China. And this is something which we saw similar to of China in Noida 5-7 years back. If you drive down today in Greater Noida or extended Noida, you'll be seeing similarity of the China which is there. You buy a property in Greater Noida, there is no tenant, and for last 5-7 years, people are struggling to find a tenant. Something similar, 10 times or 20 times of what Greater Noida is. That is something reflection in China today. So there are challenges in India which are similar to China, and China there has been a passing the parcel. You basically have investors keep parking the money into real estate, and there is no exit option. And multifold, Chinese companies have gone multifold in terms of growth and development because there has been inherent demand, and the demand has been so robust that people have been going on buying properties. How do they exit? Who will buy? Who will eventually buy it from you is a bigger question. Next slide. So we have a situation where one of the large defaults was just taken care by, hopefully will be taken care by the Chinese government stepping in and saying that the company has to pay the coupon for the local bondholders. So this is something which we have to see what's going to happen going forward. The larger question is, will this happen in India? Will this be very similar to what has happened in China? Has India seen it? We have seen it on a very small scale. We have seen recently, we've seen Unitech, we have seen Supertech in NCR, where court has come down, or the local municipality has, local court has said that municipality was in hand in glove with the developer. They built illegal floors, they built illegal buildings. Or we have seen in Bombay, which has been in the past as Campacola, or many other instances where the developers have built and investors have got trapped and there is no exit. Or we have seen recent default like DHFL, Diwan Housing, and the recent Punjab Maharashtra Cooperative Bank going down the drain, primarily keeping in mind that they had actually done circular transactions, over leveraged transactions as recently as Yes Bank did, lending money to most of those real estate developers who defaulted on payments. So we have also a similar situation what China has. The larger question is, as an advisor or as an investor, would you like to be in a situation like this, or would you like to play the game safe? So the bigger question is, if your portfolio or if your personal agenda, current situation says that I need a house for living, look at it for buying. If you're looking for a house for investing, you have to question yourself or maybe question your customer, is it needed? Are you looking at long-term investment? Because these are things which managing becomes a very difficult part. Meenakshi, next slide. I think we're done.
Yeah.
I hope I covered most of the topics, but still happy to take any questions from the audience.
It was a terrific, powerhouse of knowledge and information that you shared with all of us today. Now, just quite a few, thoughts that keep occurring. So maybe I'll just start off and ask a question. So we have seen a drop in interest rates, right? And we have seen in mortgage rates coming down to like levels which possibly we have not seen in the last 20, 30 years. So when this last time it happened in 2003-4, when the mortgage rate for a 15 to 20-year term came down to around 7.25 levels. Thereafter, we did see a massive jump in the real estate prices. As an expert in this field, now we are seeing mortgage rates in the range of 6.7 from the largest mortgage provider, which is pretty close to what the government of India's borrowing rates are and state government's borrowing rates. So what's your sense now? Is that going to trigger some kind of price movements in this sector?
So good question, Sajay. Sujay, I think we've already seen that in the last 6-7 months, property prices have gone up across the city of Mumbai or Pune. Builders have increased the price by 6 to 10%. Even Bangalore has seen that. The primary trigger for that has not been because there is inherent demand. The costs have shot up. Globally, we've seen this new trend of metals shooting up, commodity prices shooting up. Cement prices are basically being increasing. The graph which we haven't understood, that keeps going up irrespective of whether demand or not. Demand was not there, but this has led to developers increasing the price 6 to 10% to just cater to their cost management. This has increased the price in the market. This will reflect in the secondary deals. Currently, it's only reflecting in the primary deals. Irrespective of the market, whether it is north, south, east, west, doesn't matter. These prices have shot up. Now, this price trend shooting up further with regard to more demand being there is a larger question we have to see. It's a larger question when it specifically comes to city-specific question. I would not be very unfair for me to tell, oh, this is an all-India trend. The cities which are creating the job creation, employment, the fundamental factors are very robust, gives me a lot of comfort saying that these cities are worth looking at because eventually they are going to be your Bombay, Delhi. Bombay, Delhi have seen their run. Now, Bombay, Delhi are just dependent on upgradation, or Bombay, Delhi are dependent on many other factors which are primarily keeping in mind one or two industries, whether it is diamond industry, or whether it is film industry, which is currently driving, or finance industry. These are three industries which is driving Bombay. Right. But the larger question is the IT industry or technology related industries which are driving the growth in Pune, Bangalore, Hyderabad, Chennai, Gurgaon is a factor which I am very keen to look at because I've seen last 7-8 years the trend has surprised everybody. And a city location like Whitefield, which is to be a location where nobody wanted to discuss because the infrastructure issues were so bad, traffic used to be extremely bad. Bangalore, Whitefield used to be available anywhere between 4,000-5,000 rupees per square feet. Today, average is around 7,000 to 8,000 rupees per square feet. It has doubled in last 4 years. The metro is going to go live in next 12 months. There is already a run-up. primarily keeping in mind the number of jobs being created there, the infrastructure being created there. Hopefully, a situation in Bombay today, the infrastructure is being upgraded, but the premiums or the affordability is a bigger challenge. Office space in Pune today is available at 60, 70, 80 rupees per square feet on a leasing rate. Office rate in Bombay is anywhere between 90 to 120 rupees. A company will think twice. If I am basically taking office in Bombay, if I am taking office in Pune, which is 160 kilometers or 150 kilometers difference, I'm still saving 25-30%. Those are the questions which we have to look at as a investor.
So one big thing which is also getting discussed quite a few number of times is the stock price movement of these property companies. So, and they are looking at data which suggests that it is breaking some long-term resistance and so on. So would you like to give some inputs around this?
Sure. Property prices moving up.
Stock prices of property.
I'm just coming to that. Yeah, property prices moving up changes the game of any real estate company. Primarily, if you look at average realization per property, per square feet, Bangalore market was to be anywhere between 4,000-5,000 rupees per square feet. A builder's play was 4,000-5,000 rupees. If you look at 10-12% margin a builder is making, was around on 5,000 rupees is making around 500-600 rupees on an average. I'm just putting some ballpark numbers. If that price average realization has moved up from 5,000 to 7,000 rupees, the margin expansion happens. Number one. Number two, with IT industry doing well, the company's sale or so-called top line, real estate companies' top line also improves because there's demand which is being created by the number of jobs being created in those cities. So all these parameters put together, there's a lot of buoyancy or demand in companies which are catering to IT sector and IT world. Real estate companies which are catering to the sectors. Whether the company which is catering to a city like Mumbai, Mumbai local developer, what strategy they are using, again, is a very localized strategy. If you have a very big name in Bombay, which has run up significantly in last 4 months or 5 months, which Bombay doesn't attract so many jobs, Bombay doesn't have any big upgradation or maybe sudden change which is going to happen. But the developer's strategy, local strategy is acting very, helping or the stock to move up. The question what you asked me is, how do you see the real estate companies doing well? Are they doing to do well in the coming period? It all relates to how the sector is going to see scale up in demand. But mind you, most of these real estate companies follow an accounting standard, which is percentage linked completion method. So POC method, which basically says once you complete a project at every stage, you recognize the revenues. You cannot, I was seeing some large developer in India sold 500-600 crores of worth of stock in one day, stock moves up at 10-12%. That doesn't help in terms of giving quarterly results or quarterly profits. One has to look at when will the profit be recognized. The profit takes time to recognize because the project has been sold yesterday. It will take 3 years to complete and the profit will get added to the top line, bottom line only after 3 years or in a graded manner. But discounting that and giving the stock price a jump of 10-15% in one trading session or two trading sessions surprises most of us.
Okay, great. So the floor is open for everyone to ask questions. So we have a terrific, knowledge powerhouse here today with us. Everyone is feel free to ask questions. You can write your questions in the chat box. If you would like us to unmute you, we will do that. You can just raise your hand and we'll be more than happy to unmute you. You can ask your question to Mr. Om Ahuja directly. Any questions from anyone? I think there is a question in the chat box, Om. I will just read it out to you. How do you see investment in foreign properties subject to repatriation rules as an HNI investment?
This is a sector which is picking up with a lot of goodies happening in this sector. I would say goodies is primarily global citizenship. A lot of technology owners or so-called employees who are now global citizens. It would be unfair to say they're Indian citizens because they keep traveling, not in COVID days, but hopefully before COVID and post-COVID, they'll keep traveling. So everybody today wants their kids to send abroad. So if you look at most of the learned HNIs, 70-80% of their kids would be studying abroad. Today, you would see that most of them either are looking at options of buying real estate in London, buying real estate in US, buying real estate in Dubai, Singapore. All these are parameters where one has to look at whether you have end use. If you're looking at renting them out, buying just one property and renting it out, sitting in India, you have two challenges to manage. One is the property management. The second is the taxation. How will you manage the taxation part is easier because you can hire a consultant locally here who will file your returns and will manage your taxation part. The larger is tomorrow if something goes wrong with the property there, some needs to, for example, I was listening to one of my friend who has bought a property in Australia and there was a pest attack in the property which he owns there. So getting hold of unlike in India, you have very fantastic urban clap. You click a button and somebody reaches there and gets things done. In Australia, those services are still not at the press of a button. So many challenges are related to those investments. If you are having a sizable portfolio and you're looking at 2-3 investments being made in one, but let's say example, you want to go and invest to Melbourne and you're having 5-6 houses there, you can appoint a property manager and still take care of it. Or you can appoint one of these international property consultants to still take care of it. So there's a cost involved. The yield return is not that attractive that one has to rush and buy. Whether the appreciation is happening is a bigger question. In the last 13 years, what one has not seen has happened in last 2 years. So it's very difficult to say COVID has made the suffering more, but actually it has made many HNI investors have actually seen the portfolios or returns from real estate happening suddenly in last 2 years, which they haven't seen in 13 years. US market is shooting up. US real estate has shot up around 12-13% in last 9 months, which US market has not seen for last 10 years. So there are trends which one needs to see, one needs to follow. And whether the question was, should we as investors look at international market? My only submission would be, look, if you need to use it for your kids, or maybe you are traveling globally and you want to stay there, that's a different story. Dubai, a lot of HNIs in India have blocked their money. Dubai is a market where there's a lot of excess supply has been there in the last decade, and exit has become a big challenge in Dubai market. If you want to sell, you don't get a buyer. In India, whether which part of the country you buy, you can still manage to get a buyer. But in Dubai, to get a buyer has been a secondary sale has been a big challenge. I hope I answered the question of the panel.
Absolutely. So the floor is open. Anybody has any more questions, can type it in the chat box, or if you want, we can unmute you and we can ask the question. I think there is a question, Dipali, she would like.
Yes, sir. Thank you so much. It was a very knowledgeable and enhancing session. And I'd like to ask you if what would be the trend of real estate in the coming 2 to 3 years, upcoming 2 to 3 years, because I want to know for personal reasons, because real estate investment has been done by my family members. So I'd like to know what would be the trend in the upcoming 2 to 5. Thank you.
So Dipali, I wish I can answer your question in specific need purpose, because it's very difficult to give you a generalistic answer thing. How will real estate be? Like, you can easily say, okay, bond market looks attractive. The so-and-so trend of
RBI. It will be city specific, right? Sorry, it will be city specific.
City specific. It will be property specific. It will be a property type specific. It's very difficult to give you a generalistic answer. If you're looking to buy for your own use, and if you are looking at trading off, as we discussed in the past, in the few minutes, that whether you want to borrow money and buy, if it's for your personal use. Yes.
We'd like to actually sell. In fact, actually, it's UP. City is UP, and we'd like to sell the properties that are there. And some property is actually there in the process of mutation. That was the land that we got. That is a land in Delhi, but that is in that we'd like to sell. One is actually in the process of selling, and the other property we'd like to sell, that is in UP.
So Dipali, it's again a very personal question. Which part of UP? What is a specific city or a town you're holding the property? How do you basically want to tackle that? Is there a buyer for it? How much money you're going to get for it? Whether it is below the market value, above the market value, or if there's a component which you're going to get, which you're going to have a challenge to redeploy. A larger question. Overall, if you ask me, if you're holding a land which is agricultural land or a non-agricultural land in a growing city, land is a gold mine, don't sell. If you don't need money, don't sell. If you need money, sell it. If you're holding an ancestral house, there is a emotional attachment to it. It's your call, personal call. You're not going to get return out of it, but yes, it's an emotional call you have to play with. So there are a lot of other things which are not things to look at. It'll be very difficult for me to give you a very simplistic answer for this.
So I'd like to know ki how is land or real estate, probably land, you said it's a gold mine. How is it a gold mine?
So land is considered to be gold mine because see, population of India is growing and land is not growing. So cities specifically, let's say for example, 30, 40 years back, Bombay used to have a X amount of available supply land. Today, developers are struggling to find land in Bombay, so they are going and acquiring mills. So mills also have become a history now. They're going and now basically looking at redevelopment because old buildings to redevelop and builders can make money. Same way, if your city in UP, if you have a land, the city is in a growth path. For example, I keep hearing about many cities in UP today are doing extremely well. The larger question is, are they creating jobs? You have to ask whether the jobs are happening, or the city is doing well is fine, but are they creating employment so that employment will create more demand? If that is not happening, then you have to look at whether I can liquidate that money and look at redeploying that money in a city which is growing. For example, you want to redeploy it in Noida because there's an airport coming up. There is a lot of development happening in and around Noida. So Noida may give you a return which is much better. But can you take a decision which is just taking like an equity investment or a mutual fund investment by just selling the investment by pressing a button? In real estate, unfortunately, it doesn't happen so. You go moment to sell the land, take the money out, go to Noida. In Noida, if you find a good developer, the bigger challenge is finding a good developer, finding a good price, good entry level. I'm not discouraging you, but one has to do that lot of lengthy exercise in real estate as compared to a financial market investment, where things happen at the press of a button.
Yes, correct. Thank you, sir.
I think we have time for one last question. Anybody has any questions can type in the chat box or raise the hand, please. We will unmute you. I think there is a question. Do you think Government of India should allow foreigners to buy real estate in India? There's a question.
Well, foreigners buying real estate in India is more a state subject, a central subject. Land is not a central subject, it's a state subject. And larger question is whether foreign citizens buying a real estate land is a faraway question. Today, you and me buying a land in some specific states also it's bigger challenge. Recently, Himachal Pradesh has opened up. People like you and me can buy land. So there are many states in India which don't allow you to buy land. Yes, apartments and stuff in Goa. If you basically want to buy a land, there are a lot of legal challenges you have to go through. So larger question is whether foreigners can come in and buy land in India is a gray area at this point of time. I don't think government's focus is on that, and they don't want to get foreigners coming into a land and inflating the prices. If the inflation prices move up, it'll be difficult for local people like you and me to go and look at buying land in India. So there may be people who say that, oh, I will lose value, and why don't you allow foreigners to come and buy land? This is indirectly happening. Foreigners are investing through funds, and the funds are basically having FDI route. And FDI route is looking at quality investment, whether it is hotels, whether it is office complexes. Those are things that are happening indirectly. Directly, I don't think many governments can afford to think about it.
Brilliant. I think, Om, fantastic. It was a great session. It was a great session. I really thank you and all the attendees who found time today to come and listen to this masterclass with Om Ahuja. With that, we can end today's session. Thank you very much. Thank you, everyone.
Thank you.
And good evening. Enjoy the weekend.
Thank you.
Bye.